Hi everyone, welcome to our channel. Before proceeding to watch the video, please hit the subscribe and thumbs up buttons and share this video with your friends so that enough people will be able to see our video and benefit from this quick shot. So in our today's quick shot, we will look at the recognition of the transactions taking place between the company, any company and its associate. Uh, as we know, effective from September 2020's, 22nd, sorry, there is a change in the way of calculation of the contract asset and contract liabilities. So contract assets and contract liabilities. Actually, ACCA in its technical articles has always promoted the way that is actually examined right now, but the previous way of calculation using the cost to date, profit to date, where we were deducting the invoiced amount and calculated the final contract asset, contract liabilities is no longer applicable. So you should be aware that you are studying from the latest study book and workbook. Okay. Actually, we somehow covered this issue in our previous video, so you can go and check whether you are aware of this. In addition to this, there is a change in the way how we treat the transactions held between the company as the associate, especially the sales of the inventories. Basically, we know that saying associate, we mean the company on which we have significant influence, and significant influence. We know that by simply stating as an example, is the company on which we have the presence, we have the right to participate in decision making, but that's not considered as a control. So whether the company is associated or not, it should be the exercise should be taken to identify whether the investment is the simple investment, whether it should be carried out under IFRS 9, or whether it's the joint venture which will be covered under the IAS 28, or whether it's the subsidiary, and such kind of transaction should be considered under the IFRS 10. So our today's topic is not identification of the associate, but mainly the difference between the treatment of the transactions. So previously, regardless of transactions taking place between the associate, regardless of whether transactions taking place between the associate, if they were upwards or downwards, the treatment was the same. The treatment was the same. So we always, corrected that by debit calls and credit investment in associate. So as we know, we have two kind of operations, whether they are upstream or downstream. By meaning the upstream, it means that the sale take place from subsidiary to parent, or in our case, from the associate to parent. And while meaning the downwards, we mean from parent to subsidiary, or from parent to associate. So previously, if we, made our calculation, but stated that we are not interested into identification of whether this sales taken place in upward stream or downward stream, we will correct it by putting this kind of entry. This answer would have been accepted as a correct, but from the technical articles issued from June 22nd, the downwards and the upwards transaction should be separated. So if the sales took place as a downwards stream, it means from company to its associate, the correcting entry would be debit cost of sales or area. It depends on what kind of statement are you preparing, and credit the investment in associate. So if we are making the sale to our associate, based on the profit figure that this transaction has led, we multiplied that amount by the percentage of our ownership, and that amount will be corrected in our books as debit cost of sales and credit investment in associate. Okay, and because while how to say consolidating or while including the results of the associate, we are already including the amount of the transaction that took place. So if we how to say do not make this kind of transaction, then the same entry, the same how to say operation will be considered twice in our books. So in order to eliminate this, we are removing the profit figure by multiplying the profit by our on percentage of ownership of the associate, and the overall recognition would be perfect. But if the sales is upstream sale, sorry, upwards stream, which means from associate to company, then in order to correct this, we should record debit gain from movement in net assets of the associate, or briefly profit from associate. Okay, this is the P&L figure, and credit investment in associate. And if you are aware of, in most of the questions where the associates are examined, it says that dividends has been paid by the company and it has already been recorded in the P&L. We know that the receiving the dividend should be debit cash, credit investment in associate. So here again we are if we do not make the entry like this, then while considering the movement in the net assets of the associate, we will record the same transaction or the same movement in our books twice. So if there is a dividend which is received from the associate, we should eliminate this to correctly reflect the movement of the associate in our books. So basically, these are the two main changes of recognition of IAS 28 transactions. I hope that it makes clear for you. It's I'd say visible, it's crystal clear, and the treatment is straightforward. If you have any questions, you can comment below. You can join to our WhatsApp group and Telegram group. Feel free to emphasize your points, and good luck on your upcoming exam. Bye.